The S&P 500 index is the most popular in the world, with millions of people globally choosing to invest in one of the many passive ETFs that track its performance. Its appeal is not surprising, really, as it consists of the largest global companies such as Apple, Microsoft, Tesla, and Amazon. And the index consists of the largest 500 US listed companies, which account for a staggering over 50% of global market share. With advances in AI being a significant driver for global growth, buying an ETF that tracks the S&P 500 index has allowed investors to get a good return on the advances that big technology corporations continue to make. And the index has consistently provided fantastic average annualized returns over the last 10 years of about 11%, or just about 10% if you go back even longer to 2005. And this is despite the impact of the financial crisis and COVID during this period, with big 20% returns in each of 2023 and 2024. There are lots of S&P 500 ETFs to choose from, and well-known providers such as Vanguard and Ishares each have their own versions. But even though passive ETFs are designed to all track the same index to provide the combined returns of the 500 companies listed, and would therefore be similar to their competitors, not all are equal, with there sometimes being significant differences between individual ETF performance, especially over the longer term. To get a better understanding of this, let's firstly break down where ETF returns come from. And just to clarify, we're talking about passive ETFs here that are just designed to track their index and provide its return, rather than active versions that can have higher costs where you pay a fund manager to pick stocks to beat this benchmark. This benchmark could be an index such as the S&P 500 or a customized benchmark tailored for a particular investment strategy or objective. But getting back to performance and where the returns come from, a company's profits, balance sheets, and what a company's future prospects are determine its value and therefore its individual share price. And this, collectively with the 499 or so share prices of the other companies listed in the S&P 500 index, determines the overall aggregate share price of the S&P 500 ETF that tracks it. And companies listed within this index also pay dividends to shareholders. Some will pay out more than others, with some choosing to reinvest profits instead to grow the company faster, thus potentially increasing the company's individual share prices. So both aggregate company share price and dividends paid out are main contributing factors to the returns an investor will get from an ETF. But even if your ETF of choice tracks the index perfectly, there will still be costs to be deducted that will influence the return that you actually get. The first is the total expense ratio, or the ongoing charge figure. This is generally abbreviated as TER or OCF, which is the charge of the fund or ETF manager for its administration, which will include the cost of how the fund manages to continue to track its index, which is more straightforward and generally lower cost for passive versions of ETFs. And you can find this charge figure on the front page of the fund overview page or within the key information document to allow you to make comparisons between ETFs. So choosing a lower cost ETF is your first way to better your returns by reducing those costs. But a potentially more significant factor to deal with what impacts performance is tax. What, I hear you saying? You're a UK investor and all your assets are in an ISA or pension, so are tax protected, right? Well, yes, you are protected from tax in many ways by keeping your assets in one of these accounts, or tax wrappers as they are often referred to, but not when it comes to the US's withholding tax. This is because the US government taxes investors, whether US citizens or not, who receive dividends from US companies. And this is at the rate of 0.3%. That means 0.3% of all of the dividends paid by the US companies in the S&P 500. The UK has a double taxation agreement with the US, which reduces this tax to 0.15% if your ETF of choice is domiciled in the appropriate location. For UK investors, that will be Ireland, which is one of two common countries of domicile for ETFs for UK investors. The other is Luxembourg, which still attracts the full 0.3% tax deduction. Whether 0.3 or 0.15%, this tax on dividends will potentially lower the return an investor gets from investing in an S&P 500 ETF. I use the word potentially because it can often be avoided depending on your structure of ETF. ETFs track their index by various means. Some use physical replication, where the ETF duplicates the return of their index by holding the actual constituents of the index. For example, by holding the shares of every business in the S&P 500. But synthetic or swap-based ETFs do not replicate their index by holding its component parts. Instead, synthetics purchase a financial derivative called a total return swap, where the ETF enters into a contract with a counterparty and where the counterparty agrees to pay the ETF the return of the target index, including dividends. In exchange, the ETF pays the counterparty the return on a collateral basket of securities it holds, which is frequently unrelated to the index in question, if an unfunded version. Without getting too deep into this, The collateral basket of securities is used as a means of mitigating the counterparty risk of the swap provider defaulting. Although counterparties are typically large, well-capitalized institutions with strong derivative trading desks in any case. And some of the most frequently used swap counterparties due to their scale, liquidity, and regulatory oversight are the likes of Goldman Sachs, JP Morgan, and Barclays. So although counterparty risk is an additional one to think about, it's not necessarily something to lose sleep over when you look at who the counterparty generally is. The crucial point I want to make about synthetic S&P 500 ETFs is that they don't actually hold a constituent US company shares. And it's for this reason that they're often able to radically cut or even eliminate their US withholding tax bill. Moreover, US legislation exempts swaps from withholding tax when they are related to specific stock market indexes, and that includes the S&P 500. This therefore makes them a plausible way for you to shelter your assets from US withholding taxes. To illustrate this, and using data from ETF comparison site justetf.com, if you line up the S&P 500 ETFs from the world's leading providers and compare them over the longest possible time frame, you will notice that 3 have pulled ahead of the pack with a significant edge over the rest. And this is not a fluke, but a persistent return advantage that adds up over time. And there's no coincidence here that these 3 are all synthetic, swap-based unfunded ETFs. The trading back, by contrast, use physical replication to generate the S&P 500 return, owning all the index shares and paying that withholding tax. When using the longest time frame available, the Amundi S&P 500 UCITS ETF, distributing with an identification ticker of LSPX, tops the table, with about 0.21% better annualized performance figures than the lowest placed physical product on the list, and also with one of the lowest OCFs at 0.5%. The 0.21% might not seem like a lot on the face of things, but can make thousands of pounds of difference investing for the longer term, especially with that lower OCF, as the compounding effect enhances your annual cost savings. The Amundi ETF is consistently in the top 3 performing S&P 500 ETFs over shorter time spans also, only to be matched by one other consistent top performer in the Invesco S&P 500 UCITS ETF with a ticker of SPXP. It's not a coincidence that this one also uses synthetic swap-based replication to avoid US withholding tax, and also comes with the same very low 0.5% OCF TER. And both these ETFs are large in fund size and well established. The other ETF that consistently features in the top 3 is the Xtrackers S&P 500 Swap UCITS ETF accumulation with a ticker ID of XSPX. And this one manages to stay ahead of the pack, but has the highest OCF TER on the list of 0.15%. And please remember that past performance, although being consistent here, should not be used as a reliable indicator of how a particular investment might perform in the future, and should be only one consideration in the many that you should make when doing your research to find what is suitable for you. Also remember that I'm not your financial advisor, and this video is not financial advice, but it's for financial education purposes only to help you with your research. So if US companies account for about 71% of world indices, surely the same principle would apply when comparing world ETFs. Well, justetf.com did some research on this also and found that the bigger OCF TER fees and cost disparity across different ETFs can easily overwhelm a synthetic product's withholding tax advantage. So a synthetic ETF's performance would only be one of the factors for you to take a look at when researching which world ETF is best for you. When trying to find the best S&P 500 ETF for your circumstances, it's easy to get fixated on performance alone, and to then also forget the other factors that also should be considered. In addition to the replication methods of your ETF of choice and where it is domiciled, you should also seek to keep fund costs as low as possible by comparing the TER OCF, as higher costs can also cause a drag on your returns over time. If going for growth and simplicity, accumulation versions are less hands-on and more tax efficient than distributing versions, especially if held outside of an ISA or pension. Distributing ETFs pay dividends directly to you, which you then have to reinvest yourself. Accumulation ETFs automatically reinvest those dividends. Most, if not all, S&P 500 ETFs are US dollar denominated, so look for sterling hedged versions to minimize foreign exchange fees and currency exchange rate volatility. All those mentioned in this video trade sterling on the London Stock Exchange for maximum foreign exchange efficiency, and also have local variations for European investors. Check liquidity and spread and look for those with higher assets under management. If using justetf.com to compare ETFs, they have a useful red, amber, and green color coding system displayed on the ETF's overview page. ETFs with larger assets under management tend to be more actively traded, which increases liquidity. More buyers and sellers means that market makers can quote narrower spreads with less risk, and the bid-offer spread is a hidden cost to you as a retail investor. When you buy, you pay the ask price, and when you sell, you receive the bid price. The spread, or the difference between the two, is the immediate loss you incur if you buy or sell instantly. For example, if the bid is £100 and the ask is £100.10, then the spread is 10 pence, or 0.1%. Popular ETFs attract multiple market makers who compete to offer the best prices, driving spreads down to benefit retail investors. For example, the Amundi SP500 UCITS ETF that we featured typically has a high bid-ask spread of between 0.03% to 0.1%, depending on the trading hours, and thanks to its high liquidity and large assets under management, and this range will generally be considered efficient for retail investors. I hope that this video will be helpful to you with your research. Please comment below if you have any questions. I'll see you in the next one. Thanks very much for watching.